Good morning, Tennessee Valley. Welcome to Plan Today, Own Tomorrow, hosted by Guardian Investment Advisors. Appreciate you being back with us this week. If you were a regular listener, welcome back. If you're new to the show, we are going to talk about all things money on this show. Retirement, retiring well, and everything that goes into that. I've got with me this morning in the studio Tim McDermott, fellow advisor here at Guardian Investment Advisors.
Good morning.
Morning, Tim. How you doing this morning?
Fantastic. I've learned an interesting fact this week, actually, which I just thought I'd share with everybody. You said all things money, so this is actually all things money. The U.S. has never actually had a penny.
Really?
It went. They say the penny went away recently, right? We stopped producing it last year, but it's actually a 1 cent. We never actually had a penny. Did you know
It was
that?
never actually called a penny.
Never actually called a penny.
I didn't know that.
Interesting. All things money, right?
I appreciate that, Tim. We're going to talk about a handful of different things today. We're going to talk about really, I guess the overarching theme is uncertainty. We're going to talk about some political policy. We're going to talk about the markets. We're going to talk about financial success and all the things that we think about quite often here at Guardian Investment Advisors. And we'd love to talk to you about them as well. We're going to talk about policy first. A big one that we talk about a lot, and I think makes a big difference for people that are starting to get into the retirement planning process, is the One Big Beautiful Bill Act. It was passed last July 4th, 2025. It had a lot of tax implications in it, and I think there's a lot of things in it that people don't know. We're going to talk about, tips over time, right? The taxes change for that. We're going to talk about the senior deduction that was introduced there, which is absolutely huge for anybody over the age of 65. And then we're going to talk about the tax changes that were made permanent. Of course, as I like to say, they're made permanent until they're not.
That's right.
Tim, what happened with tips and overtime with the One Big Beautiful Bill Act?
Yeah, and today's show's really a lot about what's happening in current economic conditions on a macro level, right? The One Big Beautiful Bill was passed last year, and there's a lot to it. So taxes and overtime was kind of a big deal, right? Yeah. They took taxes and taxes on overtime and on tips and said, hey, if you're making XYZ and you're making overtime or you're making tips, we're going to make those tax free. Up to certain levels, right? I believe it was about $12,500 per person. So as a married couple, it could be about $25,000 worth of overtime or tips that are actually tax-free to you.
That could really help out a lot of people that have primary income that are tips. I never waited tables, but my wife did, and quite a bit of that money, right? Because the hourly rate wage they get for waiting tables or waiting bars pretty low.
Sure.
And a lot of that comes from tips.
There's some stipulations to that, of course. I mean, you have to be a W-2 employee. So if you own your own business out there, you can't just pay yourself overtime and make it tax-free, right? But
yeah, that's true.
But no, it was a nice thing to be added into the bill, and it should really put some money back into the hands of American workers.
Yeah, the senior deduction was another big one.
Huge one.
And this is the one that says for everybody over the age of 65, you get an additional $6,000 of an income tax deduction.
This was really the answer to no tax on Social Security.
That's right.
Right. And here's the interesting thing, right? We saw Trump campaign on no taxes on Social Security, and he said we're going to get rid of taxes on Social Security. Weren't really able to do that, right? And so the answer to that was let's give an additional $6,000 deduction to seniors over the age of 65. I almost like this better, Bobby.
Yeah, I agree.
It's cool because it's not tied to Social Security. If you're on a Social Security income, let's call it $40,000 a year that you have between you and your spouse that you have coming in from Social Security, and you had no other income, that Social Security is tax-free anyways.
Yeah.
Tack on another $30,000 and you get a standard deduction that's more than that. And then if you tacked on another $12,000, this extra $6,000 in deduction per person, you could be having a tax-free income at a $82,000 a year, income, right?
Yeah, it's pretty awesome because to your point, it can be used for any income, not just Social Security. These are the three things though that go away at the end of 2028. these provisions in the One Big Beautiful Bill Act are set to what we call sunset.
Yeah.
So at the end of 2028, they'll go away unless they're renewed by Congress and signed by the president. Who knows who's going to be president in 2028, 2029? Sure. I don't know that these will be extended. But because of that, we're really trying to take advantage of all these things now, especially that senior deduction that we can use maybe for Roth conversions, which is big. I mean, a married couple over 65 all of a sudden has $12,000 less of taxable income.
Sure.
And to your point, if you're not making that 80 some odd $1,000, you could really do Roth conversions up to that point and pay zero income tax on that Roth conversion.
That's right.
It's really powerful. So not only are you not paying taxes now using it, but you're setting yourself up for tax-free income in the future.
That's right. There was quite a few other things in that bill. You had tax deductions on interest on car loans. You had it brought back the Section 179 deduction that allowed you to deduct the full amount in the first year.
That's for business owners buying equipment, right?
Yeah. Sorry,
which is really important because most small business owners know you've got to buy a bunch of equipment. And you have a much more aggressive deduction schedule now that you can use.
That's right. So there was a ton in that bill. The way it affects you is different for just about everybody because there was so much. But a lot of those things were temporary, and a lot of those things were affected to rise with inflation now. I'm trying to think of a specific example, but you ended up having these tax deductions or tax bills that were put into place, and none of them raised with inflation. They've been around for 20, 30 years, but there's no inflationary rise on them, and that made a big difference as to what you're going to see overall with it as well.
Yeah, so this really provides a tax planning window right now that everybody should be taking advantage of. We know exactly what tax rates are going to be and what deductions are in place to the end of 2028. That's a fairly good-sized window, right? We got about 2 years now, that we know what we're planning for and planning with. 2028, could the current income tax rates be extended? Sure, but it's not a given thing. And I was just looking this morning. We crossed over $39 trillion in national debt. And so I think towards the end of 2028, there's going to be a real conversation about whether or not it's prudent as a country to keep these low income tax rates in place. We're in the third lowest income tax brackets we've ever been in.
So it's actually cheap to pay Uncle Sam right now.
That's exactly right. And we talk to people about that quite a bit. If you're going to have to pay these taxes eventually anyway, why not pay them when taxes are essentially on sale?
Yep.
And we know they're on sale at least through 2028. So, Tim, let's talk a little bit. We got a little bit more time in this segment. If people are interested in Roth conversions, what does that process usually look like?
Yeah. We want to look and understand what your income looks like, not just this year, but throughout your lifetime, right? This is really a pretty deep planning tool that we can use, but it's a way to say, if we have to pay Uncle Sam, let's pay him when taxes are cheap, right? If taxes are cheap right now, you just said we're in the third lowest tax bracket we've ever seen in U.S. history. Why not take advantage of that? Why not pay off Uncle Sam and ask him to go away while it's cheap when we think things are going to get more expensive? And I know in another segment on our show, we're going to talk about the deficit and why that's going to affect you down the road. I know we always hear about this big number, but it's going to cause some major effects down the line. So if taxes are cheap right now, why not pay them off now? So when we start this planning process, we're looking at your income, not just for this year, but next year and the following year and all the way throughout retirement. And we're looking at the most tax efficient way to handle income throughout retirement and to be left down to your beneficiaries, right?
Yeah, if you're late in your career, generally you're making more money than you ever have been.
That's right.
And so if you're still working, for most of the people we talk to, it doesn't make sense to start Roth conversions until they retire. That's not a blanket statement, though. It could make sense for you to start while you're still working. But what a lot of people overlook is required minimum distributions.
Yep.
The 401k plans, the IRAs, the traditional IRAs you've saved in, at some point, Uncle Sam's going to start making you take money out of those accounts, whether you need it or not, or whether you want to or not. And that's all taxable income. So even after you're retired and you're no longer working, 73, 74, 75, depending on your age, you're going to have potentially a lot more income on your income tax return that you have to pay full taxes on. and we can help avoid that. There's a really sweet window for most people when they retire, if they retire prior to RMD age, and that RMD age where it makes sense to really consider hammering those Roth conversions. Go ahead and prepay the taxes while they're cheap.
I would not wait until you retire to make that plan, though.
That's where you have to have a plan, right,
That's
before
right.
you retire.
You really want to have that put into place so that you know what you're walking into. And there might be some things we can do right now to make that Roth conversion process a little bit easier in the near future.
Yeah, and that may be, start contributing to Roth retirement accounts now.
That's right.
Right? Lose the current income tax deduction that you're having for those pre-tax accounts. It may make more sense in the future. We talked about the One Big Beautiful Bill Act. It was 500 and some odd pages, I think. There's a whole lot into it we didn't get into, but these are the highlights. And if you want to learn more about the One Big Beautiful Bill Act, give us a call, 423-710-9199. I also want to offer you a copy of our CEO Gary Thurman's book, Plan Today, Own Tomorrow. If you're watching us on YouTube or on Facebook, scan the QR code that's on the screen, comment down below book. We'll get that sent right out to you. If you're not watching on the internet, send us a text message. Just say book, and we'll get it out to you. If you're in the Chattanooga area, that number is 423-710-9199. If you're in the Knoxville area, 865-951-7526. Again, send us or comment the word book. We'll get a book right out to you. And when we come back, we're going to be talking about the national debt and why that actually matters to you. Hang tight with us. We'll be right back on Plan Today, Own Tomorrow.
We know the market is going to get worse from here. This is the biggest monthly decline in 10 years. People's 401ks took a major hit.
Well, my investments are tanking. My retirement isn't going as planned. I can't believe I let my kid talk me into buying crypto. I mean, what is that anyway?
This was the fourth worst contraction in history.
So how are you two doing?
Your financial future doesn't have to be uncertain. I'm Gary Thurman with Guardian Investment Advisors. If you've amassed a nest egg, it's time for a financial advisor to help you reach your retirement goals. This is one of the greatest tax windows in history. Now is the time to take advantage of this tax discount while you can. All of our advisors are fiduciaries that specialize in retirement planning, tax mitigation, estate planning, and more. Plan your retirement right. Call now for your own complimentary portfolio review and tax analysis.
Welcome back to Plan Today, Own Tomorrow. My name is Bobby Futch. I'm here with Tim McDermott. Last segment, we talked about the One Big Beautiful Bill Act, everything that, the high level of things that were in it, and why it can affect your retirement, and what planning opportunities exist right now to take advantage of that before it sunsets in 2028. One of the big drivers of a lot of that planning that we're doing now for folks is the national debt. We're going to talk about the debt a little bit about, in this segment, what it is, why it matters, what we think is going to happen with it in the future. And we have a big number to talk about. $39 trillion. Tim, that's a big number. That's a lot of zeros.
If you spent $1 million a day since 0 AD, you still would not have spent $1 trillion as of today.
That's an absurd number.
Isn't it?
And it's going up a big number every year. About $2 trillion we're adding to that deficit every year.
I think it's $5 million a minute that it goes up.
Yeah, it's absurd.
It's a lot of money, and it is going to impact a lot of things nationwide for us, right? If you look at the national debt, it has significantly increased over the last 2 decades. And why is that important, right? We hear this big number. I'm sure this isn't the first time you've heard us talk about the deficit. Why is it important to you? Well, here's why. Our government brings in about $4 trillion a year in income. That's taxes, income taxes, corporate taxes, tariffs, taxes one way, form, or another, right? We bring in about 4. We spend about 6. That's where that $1.9 trillion a year deficit comes from. That's where we're adding to our deficit. But our real deficit is actually about $39 trillion. When we have a $39 trillion debt, just like you owning a car or a note on your house, there's an interest to be paid on that national debt.
Yeah.
And that interest comes in the form of a treasury bond. You're essentially loaning the government money whenever you buy a treasury bond. The current interest rates are what affects the payment that the United States has to pay out to those treasury bond holders. So right now it's about 3.75%. So 3.75% is the amount that they're paying out on that $3.9 trillion. That means we are paying over $1 trillion a year just to service the debt that we currently have.
That percentage you're talking about there is when you see on Fox Business or CNN or the Wall Street Journal that the Federal Reserve has raised or lowered rates. That's really what they're talking about.
Yeah.
And so they can kind of set what interest rate they want to try to issue debt at. And that's the number. It actually affects quite a bit, to your point, how much we pay in interest. Because believe it or not, when those treasury notes come due from the United States government, oftentimes they're not paid off.
That's right.
Right? The government actually refinances their debt, just like you'd refinance a house or a car loan. And if that Federal Reserve rate is higher than what the note that they are paying off is, now all of a sudden they're having to pay more interest on that same money they've already borrowed.
Yep.
And so that's could be a really big driver now on why President Trump and his administration is putting pressure on the Federal Reserve to keep rates low.
I agree with that tremendously, because if we raise rates, which we did in 2022, all of a sudden it cost us quite a bit more than $1 trillion a year just to service that national debt. And if we're only bringing in $4 trillion, that means a quarter of what our revenue goes out just to service it, not to pay down the national debt, just to pay the interest on it. I mean, if you or I did that on a house, we'd end up homeless at some point, right?
That's right.
Well, why does this matter, right? I think this matters because at some point, some way, somehow, this has to get paid back. Are you going to be the one to pay it back? Am I going to be the one to pay it back? Are our kids going to be the ones to pay it back, right? At some point, somebody has to pay it back. And our government really only has one source of revenue.
Taxes.
That's right. So taxes kind of have to go up at some form or fashion in the future. Is that corporate tax? Is that personal income tax? Is it tariffs? I don't know. But I think at some point taxes do have to go up in some form or fashion. And that's going to make a major difference on what you're doing. We just talked in the last segment about how we're in the third lowest tax bracket in U.S. history. So if we're in cheap taxes right now, and we think that they have to go up in the future, why not pay off Uncle Sam? Why not get Uncle Sam out of your pocket, right?
Here's a little bit of a quiz show question. I looked this up earlier. What is the GDP or the gross domestic product of the United States? Looking at Tristan, the producer, too. He's looking at me like a deer in the headlights.
It's been a little while since I looked it up.
$31 trillion. So we owe more in national debt
than we bring in as an entire country.
Than we bring in as an entire country. The value of all the goods and services we sell. It's about 135% debt to GDP.
Yep.
Again, does that 135% number really mean anything? No, but it's something we can use to measure. And what I also want to think about is the Federal Reserve deciding whether or not to raise or lower interest rates isn't only about the amount of interest we pay on national debt.
Much deeper than that.
That is certainly affected by it, but it's really a policy tool that the Federal Reserve can use to either stimulate or slow down the economy. And so if inflation, we think back to the last time we had really high inflation, what was the way that the Federal Reserve used to slow that inflation down? It was by absolutely spiking the interest rates, right? The interest rates went up very quickly in a short amount of time.
Yep.
And that tends to slow down people spending money, right? If you're going to borrow money to buy a house, buy a car, you're going to think about spending on your credit cards, and that interest rate is already twice what it was a year or two ago. You may second guess making that purchase at this particular point in time, so it slows down the economy.
Your payment on your boat that you were going to buy just got a lot more expensive.
That's right.
Let's wait for interest rates to come back down.
So the flip side of that is if we keep interest rates really low, whatever really low is, right? A handful of years ago, we essentially hit zero.
Sure.
To try to jumpstart the economy. If the United States were to fall into a recession or a slowdown or a pullback, The Federal Reserve could elect to lower rates in order to have people try to spend more money. Money's cheap. You're going to go out and buy things and finance them that you wouldn't otherwise have done.
But we run the risk of.
But we run the risk of when rates are lower, you're running out of steam.
Running out of steam, higher inflation potentially.
Higher inflation.
I mean, that's what we did in 2022 to fight high inflation was we raised rates.
That's right.
We raised them pretty quickly, and that caused a potential issue, but we've brought them back down a little bit since then. I know Trump is pushing for another couple of rate cuts this year with our new Fed chairman coming into place. We'll see what happens with that. If we end up, that kind of brings up the question, well, if it's such a problem for us, if it's so expensive for us to go and service that national debt, why not just drop the debt to zero or the interest rates to zero, right?
That's right.
What is that potential issue?
Yeah, that could cause some hyperinflation, right? If things are so cheap, then people can borrow money, and that's kind of the issue. There is you cause inflation, you got to raise rates quickly again, or heaven forbid we were in a low interest rate environment and the United States economy hits some rough patch, right?
Yep.
If you're at essentially 0% interest rates, where are you going to drop them to try to incentivize the economy?
Sure, there's nowhere to go.
You can have negative rates. Japan did it, but that's really a whole different issue. You're essentially paying the government to hold your money,
Yep.
which is completely bizarre. It can't happen, but that's really the issue. So I think the Federal Reserve right now, rightfully so, is trying to figure out, all right, how do we make the national debt serviceable in a reasonable manner, right? Keep interest rates low and still have the arrow in our quiver if the United States economy should fall into rough times. I'm glad I'm not on the Federal Reserve Board.
Yeah,
They probably wouldn't have me anyway, but I'm glad I'm not.
We're in that kind of tight squeeze, right in the middle of we can't really raise them, but we can't really lower them. And so that's why you've seen rates kind of stay stagnant here recently. They're whether they raise or lower, it could negatively affect things overall, and that's kind of the scarcity of where we're going. I'll say, why does this really matter to the individual investor? Well, low interest rates are not usually good for investors. They're good for debt borrowers, though,
That's right. So they're good for spenders, not savers.
Sure. Yep. If you're a saver, you want a higher interest rate. That means you could go down to the bank and get a higher rate CD. It means you could go and get better rates on different investment programs that you're using. Fixed income programs look better when interest rates are higher for investors. But then the mortgage that you're going to get is more expensive, right, meaning that it's harder to buy that house for the younger folks who are borrowing money, right?
Yeah, and this is, to your point, really makes fixed income investing in today's economy pretty difficult,
Yep.
right? You're not really getting compensated well for letting people borrow your money. And especially once you take into account inflation and taxes you're going to get on some of those bonds or CDs, your what we call real rate of return, how that money spends at some point in the future is actually less than it was when you purchased that investment.
That's right.
So it's really something you got to pay attention to if you're a fixed income investor. We have these conversations all the time.
If you want to know why this matters, how this affects you as a personal individual who's looking to invest, who's looking to borrow, who's looking to save, come get a copy of Gary's book. It's Plan Today, Own Tomorrow. It's a fantastic book that talks about all these different topics, where taxes might be going, how to develop that income plan in retirement. And when you sit down and meet with us, we talk with you about these things. We look at overall, that's the alarm going off for debt problems right now, right? No, we look at all these problems macroeconomically, and we want to make sure that your plan is suited to prepare for them. While all these things can change and they are temporary, your plan is permanent.
When we come back on the next segment, we're going to talk about midterm elections. You're going to be here before we know it. Midterm elections have a lot of effect on the economy and the markets, and we're going to talk about what it means for your retirement planning when we come back on Plan Today, Own Tomorrow.
Hi, my name is Gary Thurman, owner and CEO of Guardian Investment Advisors. For years, our team has helped thousands of retirees and pre-retirees build a confident, predictable, and stress-free retirement plan. If you've worked hard for 30, 40 years, you deserve a retirement that works for you, not one filled with uncertainty, rising healthcare costs, or market concerns. At Guardian Investment Advisors, we take a comprehensive approach to retirement. That means we help you with building a reliable income plan so you know exactly where your paychecks will come from. Navigate Medicare with clarity, making sure you pick the right coverage to avoid costly mistakes. Preparing for long-term care needs with smart planning and protection strategies. Managing your investments with a personalized portfolio tailored to your goals, risk tolerance, and your retirement timeline. Reduce taxes wherever possible with proactive planning so you keep more of your hard-earned savings. You deserve a retirement plan built specifically for you, not a one-size-fits-all approach. Plan your retirement the right way. Call us today or connect with us using one of the many options below. Let's get started empowering your retirement right now. Thank you.
Welcome back to Plan Today, Own Tomorrow. Back with Tim McDermott and Bobby Futch. We're talking about everything in the market and in the headlines you should be worried about this year. We closed out our last segment talking about Gary's book, Plan Today, Own Tomorrow. I want to open back up with that. I think it's a great resource for anybody that is getting ready to start the retirement planning journey. It's really easy to get a copy. If you're watching us online, scan the QR code or comment the word book down below. We'll get a copy out to you. If you are listening on the radio in the Chattanooga area, text the word book to 423-710-9199. That's 423-710-9199. We'll get a copy out to you. If you're in the Knoxville area, same word, text the word book, 865-951-7526, and we'll get the complimentary copy right out to you. Tim, we talked about the One Big Beautiful Bill Act when we opened in the first segment. We talked about the national debt and why it matters to you as an investor and a retiree. And we're going to talk about the midterm elections that are happening here in 2026. There's been a lot in the news lately. We haven't quite started ramping up talking about midterm elections. Been a little bit in the news about it, but it's going to be here before we know it, and it affects markets, investors, and retirees. So I want to talk about a little bit about that, what we think is going to happen this year. Again, I don't see our crystal ball here, but the really interesting thing about this for us and for most people that we talk about this stuff with is there is a really clear trend that happens during midterm elections as an investment advisor, as an investor, and a retiree that you want to pay attention to.
Yeah, that trend equals volatility. Midterm elections drive a certain amount of volatility in our markets, and we get nervous about the unknown, right? Investors tend to react to uncertainty. That's what we see in midterm election years, especially in the summer months, is the uncertainty of who takes office. Does the party flip in the Senate or in the House? And what is that going to mean for us as an economy? So we see volatility during that summertime. What's interesting, Bobby, is it doesn't matter.
That's true, right? The market really doesn't care about the outcome of the election. It just cares that it happens, and once the market can figure out which party is in place in any particular house, it can figure out what to expect as far as policy changes go.
That's right.
And so once that happens, we tend to see kind of the shakiness of the summer months in a midterm election go away. And it tends to be the period following a midterm election tends to be a pretty positive one.
Yeah.
Especially going into early next year.
That's right. Yeah. Q4, the fourth quarter of this year, and the first 2 quarters of next year are historically the strongest 3 quarters in any election year cycle. So over that 4-year period of a presidential election cycle, you tend to see the strongest 3 quarters happen right after midterm elections all the way through to the summer of the following year. That kind of brings in some light on the situation, right? I know we're currently going through some volatility with some things that are happening overseas. We expect a little volatility through this summer, but then we expect to see some really good quarters moving forward from there.
Yeah, and you make a good point, Tim, because we really haven't truly gotten into the midterm election cycle now. but we've had some other issues, overseas, Venezuela, Iran, Ukraine still going on, right? That introduced a lot of volatility in the markets. I expect that there's a pretty good chance that that will continue through the summer and may get even a little more pronounced.
Sure.
Right? The volatility we've had beginning this year, it's been there, right? Would I say it's significant? I don't know that I would use that word yet, but we could certainly see some significant volatility going into the summer months. And I think it also doesn't help that the last couple of years in the market have been really strong, right? We saw a minor pullback at the beginning of last year, and then the market ran.
Yep.
Aside from that small pullback when tariffs were first introduced in 2025, the market just absolutely ripped. And so people just aren't used to seeing as pronounced volatility either in how big the moves are or how quickly they happen. But it really is normal. Volatility in the market can be a good thing for investors.
Do you want to talk about how we take advantage of that, or how we plan for this type of volatility in our specific planning? What makes us a little different from the big box store down the street?
Yeah, I think we should mention both of those things. And one, when we put a plan together for folks, we know there's going to be volatility in their investments, specifically in our red bucket of money. And we love to use, what we call the bucket strategy to help people diversify their retirement plan. The green bucket is vitally important, right? The green bucket is going to be your guaranteed income in retirement. That's going to be your Social Security. That's going to be pensions. That's going to be maybe some fixed indexed annuities, which we didn't really touch on specifically in the last segment, but we talked about how bonds were really just in a tough spot because of our deficit and other things. But fixed indexed annuities are a great alternative, traditional fixed income, to provide you that safety that was traditionally in bonds that I would say doesn't really exist there anymore, and provide an income. And so a structured fixed indexed annuity can really fill out that green bucket and make sure your income, your retirement income, is guaranteed for as long as you live. That's vitally, vitally important and the cornerstone of our investment strategy, which leads us back to the red bucket, which is money in the market. And that's where you see the most volatility is in the red bucket. But I would say, and we say all the time, if your green bucket is taken care of, your income is secured, you're not worried about, like Tim likes to say, go out to Texas Roadhouse
Yeah, I
on
like
Wednesday nights and get
their rolls and their cinnamon butter. It's
Yeah.
delicious.
That's taken care of. This volatility is not as big of a deal for you because you know your income is secured.
That's right.
And you can weather that volatility storm.
That's right.
And so as long as you've got your assets placed where they should be for you in your retirement plan, volatility actually provides you an opportunity to take advantage of some of those dips in the market.
A couple ways that we can take advantage of dips in the market. If you're a young investor, it's a great time to add money to your plan. If you are doing a 401k plan, you're doing this without even knowing it, right? In your 401k plan, you're consistently adding money to that plan time over time over time. And even as the market comes down, money goes back into that 401k plan. This actually works in your favor as a younger investor. As an older investor, this can go against you, which is why we've developed that bucket plan. And the green bucket secures the income, so we're not dipping in and pulling money out of a declining asset during times of volatility. The other things that you can do, if you're looking at doing Roth conversions, when the market's down, it may be a great time to do that actual Roth conversion.
That's a good point.
Because you're doing it at a higher percentage in relation to the value of the account. If you're in a non-qualified account or an after-tax account, if you will, tax loss harvesting is a powerful tool that can be used during times of volatility. That just means we're going in, we're looking for some of the losers, we're selling them off in order to take that write-off on the taxes, and then buying into something else to take advantage of the run back up.
Yeah, I really like that. It does provide opportunities. I would make a couple suggestions or maybe some warnings to folks when you find yourself in a period of volatility. You really want to not base if you're investing yourself, your investment moves on headlines.
Yep.
I don't want to get too deep in the weeds here on this because it's a delicate subject, but I don't care who you listen, where you get your news from,
Us.
right? Unless it's us, right? Unless it's us. But all the major news outlets, right? They want clicks, they want eyeballs.
That's exactly
so their headlines are going to be sensational a lot of the time. You know, they're going to make you think that the next depression's right around the corner.
That's right.
And what we really see, in my opinion, all too often is people have come in and made a decision based on a knee-jerk reaction.
Sure.
And if your plan is in place, you've used Guardian's bucket strategy, and your retirement income is secured, that plan will weather those storms. And you don't need to be as worried about the sensationalist headlines. Tim, I know you can avoid volatility by sitting in cash.
You can, but a lot of times what happens is you are sitting in cash and you make that decision to go to cash after the volatility's already happened.
That's right.
Right? That's what I would caution most folks against. If you're already in cash, if you've been in cash, now may be a good time to deploy some of that cash. But you don't necessarily want to sell and go to cash just because we're seeing high volatility. That can put you in a position where if the market bounces, you get back in too late and you miss the recovery period that you would have had. It could put you in a position where you never get back in, right? We saw that happen a lot in 2008. Investors got out near the bottom and they never knew when to get back in, and they never did.
The best days in the market historically happen within days or weeks of the worst days.
That's right.
And so by going to cash, what you're doing is kind of locking in those losses. And very rarely does somebody go to cash and get back in at the exact right time. Market timing is almost impossible.
Agreed. And this is, again, why we do our bucket system. There's a plan in place. If you have that green bucket in place to protect your income, to make sure that you have your income secured in retirement, you don't have to stress so much about the red bucket money in retirement.
I would actually say for the folks that we work with and put a plan together for, I won't say they're excited about market downturns, but they see it as an investment opportunity.
Sure.
Most fixed indexed annuities now will allow a 10% free withdrawal. And so you've got some capital there that you could redeploy into the market and take advantage of some of these downturns. It's a really, really good tool to use for retirement investment planning. If you are getting to the point where you want to start thinking about your own retirement, I invite you to get a copy of Gary Thurman's book, Plan Today, Own Tomorrow. It's an absolute great book. Read it, then give us a call, and we can sit down and have these conversations directly with you. If you're watching us online, click the QR code, comment the word book down below. We'll get a copy out to you. You can also send us a text message. If you're in the Chattanooga area, text message the word book, 423-710-9199. If you're in the Knoxville area or any other far-flung location, we'll ship countrywide. I think we will. I guess we will now. 865-951-7526. That's 865-951-7526. We'd love to get a copy out to you, have you read it, and have a conversation with you. We're going to come back in our final segment. We're going to talk about Federal Reserve changes this year, energy prices, what we see next coming in 2026. So don't go anywhere. Join us on our last segment on Plan Today, Own Tomorrow.
We know the market is going to get worse from here. This is the biggest monthly decline in 10 years. People's 401ks took a major hit.
Well, my investments are tanking. My retirement isn't going as planned. I can't believe I let my kid talk me into buying crypto. I mean, what is that anyway?
This was the fourth worst contraction in history.
So how are you two doing?
Your financial future doesn't have to be uncertain. I'm Gary Thurman with Guardian Investment Advisors. If you've amassed a nest egg, it's time for a financial advisor to help you reach your retirement goals. This is one of the greatest tax windows in history. Now is the time to take advantage of this tax discount while you can. All of our advisors are fiduciaries that specialize in retirement planning, tax mitigation, estate planning, and more. Plan your retirement right. Call now for your own complimentary portfolio review and tax analysis.
Welcome back to Plan Today, Own Tomorrow. I'm Bobby Futch here with Tim McDermott. We appreciate you being with us every week. Today we're talking about a bunch of things that are in the news that you should be up on and how it affects your retirement planning. We're going to finish today's show just kind of all over the place. We're going to talk about changes to the Federal Reserve. We're going to talk about energy prices. And then we're going to prognosticate a little bit about 2026.
Isn't that predicting?
Predicting. Unfortunately, I wish we could predict it, but we could talk about some things that we're certainly keeping an eye on. The Federal Reserve, we talked about that earlier in our second segment, how much really power they have to affect the United States economy and how it operates for both for savers and spenders. But we're going to see some changes to the Federal Reserve this year. Tim, what are some of those changes?
New Fed chairman taking place. Believe that happens in May of this year.
That's right.
And when that happens, we may see some more drastic moves happen with rate cuts. I know Trump is actually pushing for that pretty hard to have a couple more rate cuts happen this year. We talked in our second segment about the dangers of rate cuts or rates rising. So it's a kind of a delicate situation that needs to be taken very carefully. It could affect what happens with our national debt. It could affect what happens with inflation. Unemployment rates, I know, play a little bit of an effect in that as well. So you want to be careful about that, but that's not my job. So we're just going to watch and see what happens with it overall. It could be some changes that we're I should say expecting to see in the near future.
Yeah, I would agree with that. We're gonna plan for the Federal Reserve chair to be approved, right? Congress has got to say yes. That's the Senate that says, yeah, we'll let him in there. The gentleman that's up for nomination is what I'd call a Trump ally, right? And so he's going to be a lot more inclined to try to get the other Fed chairmen to decrease rates, once, maybe twice in 2026. So towards the end of the year, we may see rates lower, maybe in the 3.5%, 3.25% area.
Yeah, I think they're expecting roughly 2 rate cuts this year at a 1/4 point each.
Yeah, so we need to certainly pay attention to that. Again, savers are going to be hurt by that a little bit.
Sure.
You're going to see your CD rates come down. You're going to see your savings account rates come down. But it may also help, kind of spur the economy along a little bit.
You also see fixed income yields drop a little bit.
That's right.
If that's the case. So something to look out for and watch for. A lot of folks, and this is interesting, we see this a lot. A lot of folks come in. When you come in, you sit down with us. One of the things that we are going to do is look at your current situation. We want to understand how you're currently set up. That includes taking a look at your current financial statements, and we'll run each individual holding through a few different analyzers that we have. What that will do is kind of pull out how you're invested, how you're diversified, what sectors you're invested in, how much is in fixed income versus stocks, what kind of internal fees are involved there. And we end up seeing a lot of times, this is surprising to folks, that they don't know exactly what they're in. Yep. And how would you, right? You're probably in 2 dozen different mutual funds maybe, and those mutual funds are made up of 200 to 300 different holdings, individual holdings, right? And what we end up finding a lot of times is that folks are in fixed income assets. They may even know they're in fixed income assets, but they don't know how it's affecting their portfolio.
Yeah, and with rates dropping, that's even more important because it's going to be less, the yield's going to be less. You're going to be making less money on those investments. One of the most popular investment styles we see a lot of, and they're really popular in 401k plans, are target date funds. They're really simple on the surface. It's an ETF or a mutual fund that has a date attached to it, and you're supposed to pick the one that's closest to the day you're going to retire.
That's right.
Why is that important? Because those managers of those funds, as the closer you get to your retirement date, they get out of equities and they get into fixed income.
That sounds great, right?
That's right. Traditionally, it was the safer investment. Back when rates were at a normal place, they were getting good yields, there was room for them to move down and appreciate in value.
It's getting more and more conservative the closer you get to that date.
But now you're not nearly as safe as you used to be in fixed income investments, and they're not paying very much.
That's right.
So you may be getting prepared and getting closer to retirement, and your portfolio isn't doing what it needs to do for you. And to your point, when you come and see us, we'll run that analysis and tell you exactly what you've got and how it's working for you and how it may be improved. So keep an eye on changes to the Federal Reserve this year. It could have big implications for fixed income investors.
Much agreed.
Let's move on to the economic outlook. This is a weird year we're in. We mentioned earlier about a midterm election. We mentioned the war in Iran, Venezuela. There's a lot going on. The Strait of Hormuz is something that we're keeping a close eye on. 20% of the world's oil comes through that waterway, and right now it's essentially shut down.
Yep.
And so there's a lot going on. Let's talk about the things we're looking at very closely in 2026 and kind of recap in our previous segment what we think this year could look like for investors.
Yeah, so we've seen problems with Venezuela. We've seen our issues with Iran. There's a lot of international tension, including the Ukraine, Russia tensions that are happening. There's a lot of international tension. All of this is slowing some of the trade, right? We're not able to get through the Strait of Hormuz, which is not allowing us to get oil to the places that we need to, and spiking gas prices. As gas prices spike, cost of delivery goes up. You end up seeing all kinds of other effects. In fact, a lot of tech companies use oil in the factory process of what they're making. That means chips. That means production goes down, and it causes other issues, supply chain issues.
Yeah,
right?
if you're a manufacturer or even if you're in a service company, energy prices affect you. It's one of the major inputs to most companies.
That's right.
In the United States is how much they pay for their energy. If it costs the restaurant more to keep the lights on, then they're going to have to raise prices, for example. So that's something that doesn't just affect oil companies in general. I would say, as a matter of fact, they're the ones that stand to benefit from it the most, right? They're going to have higher prices. They can raise their prices quicker than a lot of other companies can. But energy prices is certainly something we're keeping an eye on because it's going to permeate through all of the economy. We're still seeing AI is a big thing. Has been for a while. It's not going anywhere, I think. And we're still seeing really good performance out of the Mag 7 and others, what I call AI-driven growth.
Yep.
Right? We're seeing just kind of outsized gains in price appreciation in a lot of those securities, have been for several years now. I think that'll continue.
The one thing I think that needs to be careful with AI, AI is a very powerful tool. If you spend any time messing around with ChatGPT or any of these other AI tools that are out there, you'll notice how powerful it is. I think at some point we're going to see some more heavy regulation involved with this AI movement. We've dumped a ton of money into AI development and looking at where it's going to go and how to take it to the next level. As the issues come up or arise of how do we regulate AI, how do we protect ourselves from AI, taking over, if you will. You may see some kind of pullback in that area there. So that's something to watch out for on the AI front. Let's talk about inflation for a minute. Inflation's, I think, a sore subject because we just saw the effects of it not 3 years ago for hyperinflation. 2022 was a big deal. We just talked about some of these things that are happening economically that could cause some inflation to go up. If we lower rates, we could see inflation go up. If we see energy, this energy availability reduced, we could see inflation go up. If all these different factors that are kind of applying over time, inflation's really could be a problem again in the near future.
Yeah, I agree with that. Certainly, there's a lot that is on the table now that we're keeping an eye on because of that. Numbers are still fairly low, about average, but there's a lot of things kind of boiling right below the surface that we want to keep an eye on for that. Folks, we talked about a lot that's going on in today's segment. We talked about the One Big Beautiful Bill. We talked about midterm elections. We talked about volatility. All of these things are items we follow and we take into account when we put your individual retirement plan together at Guardian Investment Advisors. We mentioned briefly the bucket system we use for everybody, our yellow, green, and red bucket system. It makes retirement planning and retiring with confidence very easy for most folks. I'd love to be able to do that for you. Come sit down with us. me and Tim here in Chattanooga, Brogan up in our Knoxville office, and see how we can help you retire confidently. So all of these things we talked about today, while they're interesting to talk about, won't keep you up at night. I also invite you to get a copy of Gary's book, Plan Today, Own Tomorrow. We talk about the buckets. We talk about retirement planning. We talk about taxes, long-term care. Everything you should be planning for in retirement is in Gary's book. So if you'd like a complimentary copy, scan the QR code that's on the screen if you're watching us online. Comment the word book down below. We'll get a copy out to you. If you're here in the Chattanooga area, text the word book to 423-710-9199. We'll get a copy out to you. If you're in the Knoxville area, the number is 865-951-7526, and we'll get this book right out to you. A great book for anybody that is getting ready to think about planning for retirement.
Love
Tim,
it.
great show.
Fantastic.
I enjoyed it today. Everybody, thank you, as always, for joining us every week on Plan Today, Own Tomorrow. Look forward to seeing you next week and hearing us on the radio. Take care.